Welcome back to Higher Exchanges, the #1 independent cannabis investing show, where we break down complex cannabis markets into clear insights you can actually use. Here are your hosts, Jesse Redmond and Morgan Paxia.
Welcome back indeed. I am Jesse Redmond, Chief Strategy and Investor Relations Officer at Leaf Brands, and I'm back with the very tan, the very grizzled veteran. His name is Morgan Paxia. Morgan, how are you, man? Morgan, can you hear me?
I'm doing great.
Okay.
It's a hot, steamy summer in America right now, but we're doing great. Yeah.
And I'm really excited to have...
You guys can hear me?
I can hear you, Morgan. Why don't I throw it over to our guest? We're really happy to have Dan Ahrens, Managing Director and Chief Investment Officer at AdvisorShares. Dan, appreciate you taking the time.
Thanks, Jesse. Happy to be here. And hello, Morgan, long-term friend, and who might want to reboot because he seems to be on a nasty lag behind us right now.
Are you okay there, Morgan? Or are you lagging? I'm going to send my buddy Morgan a text. And just tell him.
You guys are robots right now. Shoot.
Morgan, if you can hear me, why don't you exit and come back in or do something? Because it seems like you're on a pretty good lag there. Sorry, guys, just texting Morgan to exit and come back. But we do that, Dan. Let's let Morgan work out the kinks, as we say in the industry. Yeah. You are a fascinating guy, Dan. You have a lot of stuff going on over AdvisorShares, and you have an interesting background as well. So why don't you tell us a bit about who you are and what you're up to over there at the AdvisorShares complex?
Sure. Well, I think a lot of people that follow cannabis closely, at least, might know. But, I've been managing ETFs for 15 something years, and I managed mutual funds before that. And back when we first founded AdvisorShares, along with Noah Hammond, it was his baby. He hired me and thought at some point, we might need to do a Vice themed ETF, because I had founded this thing a long time ago called the Vice Fund, mutual fund that invested in alcohol and tobacco and gambling and all that good stuff back before anybody ever imagined investing in cannabis. And, you move forward a number of years. We had a number of other active ETFs going. We have one of the very first active managed exemptive reliefs for ETFs. So we're kind of the longest tenured active ETF shop. And active doesn't mean overly active. It doesn't mean tactical. A lot of people need to understand this. It simply means it's not an index. Mm-hmm. And I'll skip ahead to cannabis investing. You don't want an index that forces rebalances every month or every quarter. You want an actively managed cannabis ETF, even if active means you're being inactive. You're not forcing rebalances. Active means you're simply not following an index, and you probably don't want to upset the apple cart. But I digress. AdvisorShares has 17 funds. We have a number of different portfolio managers and some sub-advisors of some of those funds. And a number of years ago, people started looking at cannabis investing. I said, no, that's probably not going to work. There's not enough to invest in. It's not liquid enough. It progressed, though. It progressed a little bit. So we were one of the very first applicants to the SEC for a cannabis ETF. They asked us to get legal opinions. We went to a third-party legal firms, not our regular counsel. We went to people that had specialties in investment companies and cannabis and got legal opinions. And then we got another legal opinion that about investing in cannabis and investing with total return swaps. We were the first company to do that in the cannabis space, because that's the only darn way that you could invest in U.S. plant-touching cannabis companies. So we invented that. Now there's billions and billions, if not trillions of dollars in mutual funds and ETFs using total return swaps for other purposes. We only invented the part of using it as a substitute for investing directly in cannabis stocks. A lot of other cannabis funds have come and gone in that time. And we started off with our fund YOLO, which is now a global strategy. And then we, about a year later, invented MSOS as a US only strategy. And it happens to be by far the largest and most liquid cannabis ETF in existence, floating somewhere around $1 billion.
And how big is YOLO, Dan?
YOLO's under $50 million. It's I don't know, $35-40 million in assets, which is sizable for a cannabis ETF, but much smaller than MSOS or MSOs, if you want to call it that. Because I think it just shows how many investors, how many people think that the opportunity that we're still waiting for is on the U.S. side of the border rather than more the global reach strategy.
Yeah, that's interesting. MSO or YOLO was first and a broader strategy with more diversification, which typically would, you think, earlier launch, broader mandate, typically more AUM. But in this case, people have honed in on that MSO opportunity as the one they want to target.
Usually, and also performance. There's a lot of different time frames that anybody can look at, but for a large part of its existence, the fund YOLO was the top performing cannabis ETF in existence. Again, various time frames. And that's really flipped in the past year. Once we got the executive order from Trump, cannabis stocks, US side really took a big pop in the fall with a great deal of volatility. Don't want to forget that. But it's certainly cooled off and got stagnant in this calendar year. But MSOs has outperformed its sister fund, if you want to call it that, YOLO, more recently.
Well, Morgan continues working out the kinks. So why don't I jump in and tell you a little bit about our great partner at Flowhub and thank them for the continued support of higher exchanges. They recently launched their 2020-2026 State of AI and Cannabis Retail Report, and one statistic really jumped out to us. Nearly 50% of cannabis retailers are already using AI in some part of their business. Think about that for a second. 2 dispensaries on the same street, same products, same taxes. One is leveraging AI to streamline operations, while the other is relying on late nights and manual processes. Over time, that's a competitive advantage that's only going to widen. That's just one of the insights of the report. Head over to flowhub.com, check out the State of AI in Cannabis Retail 2026. Full of interesting data. I loved it. Tons of practical insights. Check it out, flowhub.com. Thank you for your support. So Dan, let's talk a little bit more about the specifics of the funds. I always start out saying, like, what's the opportunity set right here? Like, what can we do? What's the investable universe? To me, that's the first question in due diligence is, where are you guys fishing? What pond are you in? So Dan, help me understand what qualifies a company for MSOS and YOLO. Are there any hard criteria their investors should know?
Well, again, YOLO was the first fund in existence, well before MSOs. And it's interesting, when we first filed a prospectus with the SEC and we're speaking to the New York Stock Exchange, which is our listing venue for this fund, and talking to BNY, formerly known as BNY Mellon, about custody and settling trades and so on, it set off a lot of bells. People had big concerns. How the heck can you invest in cannabis? And that's even after Canada, or around the same time they legalized, and these Canadian companies were able to list on some of the exchanges. But it still set off all kinds of bells. So for your criteria, we're not talking about a typical fund where our criteria is market cap, liquidity, size, cash flows, all this fundamental analysis you can do on a stock, and writing a prospectus about what are the principal investment strategies, what are the constraints. No, the exchange, the New York Stock Exchange, and the bank were only concerned with what is legal and what can they custody. And we had to do a lot of negotiation with them And as I said, we the SEC says, nope, you need to get a third-party legal opinion on this thing and supply it to us. And everybody came down to the same criteria. The stock better be listed on NYSE or listed on NASDAQ or listed on the Toronto or even the Toronto Venture. Later, they expanded that to Australia for the small handful of stocks that makes a difference for, a very small group. And it's interesting, Jesse, that in the years that followed, virtually all of the big wirehouses and banks and brokerages came out with formal cannabis policies that very much mirrored that same set of policy constraints. If you aren't listed on NASDAQ, NYSE, NYSE, or the Toronto, you are blocked throughout BNY Mellon. The same thing happened to Cowen, who used to be very big in the cannabis space and got acquired by TD Bank. And again, whether the constraints are behind the scenes or in front of the scenes, the same thing goes for all the big bank wirehouses like B of A Merrill and Morgan Stanley Chase and JP Morgan and everybody else. So the criteria, you got to be listed on those exchanges. Then it's a pretty darn small universe of stocks that are listed on those exchanges and have even workable price, liquidity, trading volume. And that's a small universe of stocks. Then we don't want the fund to be a market cap weighted index, and we're actively managed, even though we're not very actively managed. As a portfolio manager, we use a lot of outside information and get to decide what we want to invest in. Simple as that. But it's really evolved over the last 5 years, as you guys can imagine.
And does uplisting change that investable universe, Dan?
100%. Yes, it does. Uplisting is a beautiful thing. But, the Thrift's got to discuss that a little bit, because it is a monumental occasion when Trulieve got listed on the New York Stock Exchange. I mean, kudos to them. I mean, great job. But you guys and everybody else probably noticed they were pretty silent before that happened. There were some rumors out there. People thought I think that might be happening. I think there's discussions happening. But I think Kim Rivers and Christine and team, didn't want to upset the apple cart. They were treading very lightly. They wanted to see it to fruition. So what they did is they got listed on the New York Stock Exchange. Then they got in front of all the big investment firms in New York, and I know they've been having these meetings, and because we talked to all those same people, but they didn't really get to go on a road show before the uplisting. And then, hey, Glass House followed just a week or two later with their listing. Again, a great thing, and it's frustrating as hell that the marketplace doesn't seem to really care.
Yeah.
I mean, we all know that it's a huge, huge occasion, but the outside market doesn't care. And we need to come back and talk about it. Goes to the state of cannabis overall. But in my fund, it is a wonderful thing, Jesse and Morgan, that I owned very large amounts of Trulieve and very large amounts of Glass House. And I held it with four different swap counterparties.
Yeah.
Registered with the SEC as security-based swap dealers and big firms, but I still had to spread out all that exposure because those firms don't want to own 10 or 15% of a company, any company. They don't want to own too much of Trulieve or Glass House. I'm also spreading out my counterparty risk. I'm also, juggling fees and capacity between all those firms, all sorts of things. So I got to take a very large amount of what I held via total return swap of Trulieve and turn it into stock. It's not much more complicated than that. I sell swap, I buy stock at the same price, at the same closing price. So I'm not upsetting the stock price. I'm not putting pressure on the bid and pressure on the ask to move tens of millions of dollars. I'm simply, it's funny because some people say, do they really own the stock? Well, yeah, of course they own the stock. So at a swap counterparty, they own the stock to cover their backside over the swap that they're giving us. And I simply sold the swap, bought the stock from them, had it settled to the fund's custody at BNY Mellon. And that lowers costs. It improves, ease and tax efficiency of the fund, all sorts of things. So did I move it all to stock? No, because the fund is so top heavy, so concentrated in its top 5 holdings that I own those positions directly via stock, and I still own them via total return swap. Long answer there for you.
No, it's good. No, I think it's an important conversation. Welcome back, Morgan, in case you hear his voice again. Morgan, I'll keep cruising on the agenda until I get to position sizing and loop you back in, but feel free to jump in along the way. But I think we're having a valuable, nerdy conversation here. And I think that a lot of people, because we have a very nerdy audience in a good way, I think a lot of folks will understand this. But just to be clear, what Dan's talking about is he wants to have a New York Stock Exchange listed vehicle because it attracts more investors, will have more liquidity, but he can't do that owning these cannabis names in a normal long fashion when they're on the OTC. And so what Dan is doing is they've done some financial engineering, which is rather clever, which is going through what they call a total return swap in order to get that exposure. So just to make sure everybody understands it, you have MSOS over here. You'll have a counterparty in the middle. I'm going to use Goldman Sachs, super blue chip, AAA rating, I think. And then over here, you have the actual stock. So in the case of what Dan is doing, MSOS goes to Goldman Sachs. In my hypothetical example, Goldman Sachs issues a total return swap in the amount of the exposure they have to the position. So let's say in this example, GTI is over here to the tune of $10 million. You don't actually own GTI in this case, Dan. Correct me if I get any of this wrong. You own the total return swap with Goldman Sachs. Goldman Sachs theoretically covers that position by owning the long position of the stock. They return to you the performance of GTI minus the cost of the total return swap, which we can get into later, and that's what your end return is. So it's a little bit of clever financial engineering, but it has 2, in my opinion, risks or downside for all the benefits. One is that you have the cost, which we can get into later, and then number 2, which I don't want to steal too much from the agenda, is you do have that counterparty risk, which I think is an important thing to understand. Did I get that mostly right, Dan?
Yeah, very, very much right. And, you said we're, being nerdy on this, but I really want people to understand what the fund does, what the fund is, how the fund works. So it's important to understand this.
100%.
A little while ago, I just got off a webinar we were doing for a group of investment advisors. And one of the questions was, well, do institutions use total return swaps? Are total return swaps common? Yeah, very common. There's trillions of dollars used in total return swaps. And it's public information that you guys can look up who are registered security-based swap dealers. That's a SEC law that changed, or rules, not law, that changed a few years ago. And yeah, Goldman Sachs and every other large wirehouse and underwriter is a security-based swap dealer. So the bottom line is, when we talked to the New York Stock Exchange, when we talked to the Bank of New York Mellon, I wanted to have a investment company ETF, same as a mutual fund. We cannot buy and settle and custody GTI stock simply because it's listed on a secondary exchange in Canada. It's only traded OTC in the US, and it is on their formal cannabis policy. That's a blocked stock. For now, I think that's all changing. We'll talk more about that in the future. But for now, GTI is a blocked stock. It is not allowed to be custodied at Bank of New York Mellon. So we use a total return swap. And some people say, well, how does the fund price it? Well, I'm looking at my screen right now. GTBIF is exactly $7. It's $6.99 bid by $7.00 ask. If it ends the day like that, that is how the fund prices GTI, exactly as if we owned 24 million shares and change of GTI, which the fund does. The total return swap is exactly as if we own the stock. Now, there are trillions of dollars in other funds. Thousands of funds use total return swaps. They're usually use them for other reasons, though. They're usually using them for leverage.
Yes.
2 times funds, inverse funds, all kinds of exotic things, basket swaps. We're the people that invented using those swaps exactly on a 1-for-1 basis as if we owned that cannabis company directly. Nothing more, nothing fancy, not leverage, not exotic, just a way to hold 24 million shares of GTI indirectly through those counterparties that you mentioned.
Yeah, no, it's clever engineering. You hit the nail on the head there, Dan. I used to run a leveraged fund of hedge funds, and that's what we did. We used 2-to-1 leverage, and we used a total return swap with Goldman and Credit Suisse to accomplish that. Yeah. And that was back in 2005. And so it's kind of cool. Common. Yeah, it's kind of cool to see it 20 years later, engineered in this way. But let's move ahead and talk a little bit about I think maybe all this stuff matters, but what really matters to me is the stock selection process. Like, how do you, I think people are curious, how do you end up with the positions that you do? Like, what do you look for in companies, Dan, when you're looking across? Let's just take MSOS, because I think that's the bulk of the assets and makes the conversation a little bit easier. But when you're looking at that investable universe, where do you start and what are you looking for in these companies?
Well, that investable universe is very limited. It's a limited universe of stocks. And as these funds have evolved, the fund MSOS, AdvisorShares Pure US Cannabis ETF, has a mandate to invest primarily in US cannabis-related companies. Now, at one point, we held some of the REITs. We held some of the ancillary companies. We held some other stuff. I really quickly learned that your average investor or advisor wanted this fund, to actually hold what its ticker implies, MSOs. So I thought, if that's what people really want, and are investing in this thing, that's what we should give them. So I made a portfolio manager decision. Even though we could hold ancillary companies, we could hold the REITs, I wanted this MSOs fund to be pretty pure multi-state operators. Well, now, Jesse and Morgan, that's a pretty darn limited universe of not only who they are and what they are, they're publicly traded, can I even invest in them, but which ones are large enough and liquid enough. So, there's been changes over the last couple of years, but gosh, Curaleaf, TrueLeaf, and GTI are now pretty far and away the largest, most liquid, most expected, if you will, which still matters, tier 1 companies. So those are the top 3 holdings. But Glass House is now the number 4 holding, and that's partially through position sizing by me, and partially just by appreciation. Stock A goes up more than stock B. It's now a more heavily weighted position in the portfolio. And with this fund, I've said over and over again, we don't want to be very active. I don't think anybody really wants me pounding the heck out of the bid or the ask on any of these stocks right now, as we are waiting on federal reforms to hopefully make these volumes go up and make these things heavily traded. So if I see a stock like Glass House through appreciation, through stock performance, turning into a heavier weighted position in my fund than Verano or Cresco Labs, I've let it ride. Does that make sense?
It does. And so, like, amongst those top few names, Dan, like, how do you arrive at Curaleaf, for example, being a bigger weighting than GTI and TrueLeaf? Like, what do you like about that business that justifies the weighting?
Yep. And that's where, again, you get into what is an actively managed fund and what is an index fund and so on, because that's a very common question, Jesse, and I appreciate it. And it's partially portfolio manager preference. And again, it's partially appreciation. So there are index funds out there, and there was an index fund in cannabis land that was really pissing people off a couple of years ago, doing their quarterly rebalances and really upsetting the apple cart, rebalancing pretty illiquid stocks. So that's one we don't want to do. Two, as an investor, everybody has a brokerage account. Pull up a darn chart. Look at Curaleaf versus GTI over the last year, over the last year and a half. One of those has greatly outperformed the other one. And it has, so again, the number one position in the fund is Curaleaf right now. A big part of that is appreciation. It is simple stock appreciation. And I have chosen not to do a forced rebalance and trim that. I've let it ride and it's risen to the top. And
let me pause you there.
Portfolio manager decision. Oh, go ahead. Go ahead.
I was going to pause you there. But there are my old job was hedge fund due diligence and interviewing hedge fund managers. And there's some people that will let winners ride like that, almost a momentum trade in some ways. Then there's some people that will use that as an opportunity to rebalance and say, okay, Curaleaf's ridden, but it went from 1-time sales to 3-time sales, making up metrics. GTI is lagging, so why don't I sell that winner and rotate into something that might be more undervalued as opposed 100%. To keeping that momentum trade?
It's a great point, and this is where we get into cannabis investing has turned into one of the strangest investments and different things in a portfolio manager mind than I ever imagined, because you guys probably know that I also manage AdvisorShares Psychedelics ETF. Plug, ticker symbol PSIL. And Jesse just a couple weeks ago announced Eli Lilly acquiring our largest holding, Ty Beckley. And I sure as hell trimmed off some of that winner immediately. I have gotten very, very inactive in managing MSOs very purposely, because I think we're all in a waiting game right now. We are waiting on announcements of, the briefs that are due next month from the ALJ. Everybody's in a weird waiting game, and I am choosing to sit on my hands for the most part in MSOs management. I'm even more active in YOLO management. I have turned more inactive, very purposely so, in MSOs, because I also like the makeup of the fund right now. I am perfectly happy having Curaleaf and a TrueLeaf right behind it, GTI a little bit lower weighted. And I'm happy that Glass House has risen into the number 4 position. So I'm eyeballing these all the time. I do have the ability to make changes in these at any time. At some point I have to decide when I'm going to peel off some C21, because that stock's going to go away. But you know what? Are these stocks doing great lately? Are they doing lousy lately? Is having a low risk position in a company like C21 that's getting acquired a good thing in the portfolio right now? Yeah, it's a good thing in the portfolio. So yeah, I am, perfectly happy with the current makeup of the weighting of the holdings in MSOs right now. If I had money burning a hole in my pocket, then I might add to different stocks than adding over the portfolio overall. That's a separate question. But tactically rebalancing, selling stock A and buying stock B, I am very purposely choosing not to do that. And I'm doing that more than I have ever done in a fund before, or I'm doing in any of our other funds that I manage right now, because of this wacky world of cannabis investing we're in right now. Yeah. I feel like we're in a twilight zone.
Yeah, right.
Now, let me go back to Curaleaf. Yeah. I still think Curaleaf might have more torque than a couple of the other companies. Now, torque is a word that people in cannabis land wanted to start using over the last 6 months because they thought it sounded cool. But it's which of these companies might have more upside when things change. We're all waiting for things to change. And it might be a slower process than any of us hoped for. When those changes happen, it's still going to be a process. But this is when you get into just personal preference and my own opinions as a portfolio manager. If we have the real rescheduling that we think is all coming, if we have the ability to get listed on NASDAQ or the New York Stock Exchange, I happen to like Curaleaf a great deal just for its look and feel and institutional acceptability and view from the outside world. And we're living in a world right now, guys, where we have a bunch of cannabis investors that are pretty up to speed and know cannabis investing. And then we have the rest of the population. And our cannabis world is pretty damn small and pretty damn tight. I'm talking about your neighbors, coworkers sometimes, anybody else that's outside of our cannabis communication. They are clueless about the opportunity happening in cannabis right now. And it's not much different. And I know from experience that Kim and Christine and team have been meeting with major firms in New York, and they're all saying, this sounds great. And they're sitting and waiting still. Everybody is waiting. Even the companies like Glass House and Trulieve that just got listed on the New York Stock Exchange. Wall Street doesn't care. Individual investors don't care. Nobody cares right now. Everybody's waiting. And I'm pointing out this whole long story because when that changes, I think, unfortunately, GTI has gotten off of a lot of people's radar. It was the darling 2 or 3 years ago, always viewed as the highest quality. Everybody still agrees they got the best balance sheet out there. But I think Curaleaf is the big winner in outside people's eyes as the biggest cannabis company. I think that gives it torque to new investment.
What do you think? So if you guys can hear me now, sorry for the technical issues, but I'm back.
Without delay.
Yeah. So interesting point, because I was going to ask if you noticed any liquidity changes with Trulieve and Glass House being listed. Because I've been hearing similarly is that, yes, they're listed, but it hasn't really resulted in much flow activity change. But, have you experienced that at least with, like you said, I know you've been very inactive and I've watched that. Jungle Java does a great job keeping tabs on it and reporting. And like a year ago, you were still, seemed like there was more work, and now you're, to your point, in this waiting game. But should new capital come in? Have you noticed a difference with your ability to trade in those names, like Trulieve and Glass House specifically being the two?
Great question. Great question. And no, for the most part, I agree. It's just frustrating as hell that the outside world doesn't seem to care that those stocks are listed on the New York Stock Exchange. Yet, are they now more tradable? Are they more liquid? Absolutely. And I'm looking at my screens right now, and Curaleaf, they did the reverse split, so they're $8-something, and Trulieve was $8-something on their own already. Trulieve has traded 800,000 shares today. That's good for Trulieve. That's more volume than we ever used to see, or on an average day, regular days, than we used to see normally on Trulieve. So yeah, there's more volume trading there. Glass has traded almost 400,000 shares today. So a little bit more volume. Again, they are listed on the New York Stock Exchange, and now they are technically allowed to be traded and custodied at a lot more venues, like throughout BNY Mellon and Pershing, for instance. They were always available at Fidelity and Schwab and a few places, but Trulieve and Glass House are now available through a lot more brokerages and venues. But as you kind of alluded to, Morgan, and I said, most people don't care. There's just not that outside investors. It hasn't hit the mainstream news. No one's really taking notice or making a difference, or we're in this waiting game. So more liquidity, more tradability, but not the real boost that everybody would hope for.
What was are you hearing feedback as what is the new goalpost that Wall Street's waiting on?
The next announcements. It's really the next step of the rescheduling. And again, it technically doesn't matter to Glasshouse and TrueLeaf, but it matters.
Right.
And,
yeah, it's more just the continued process. And
yeah.
Yeah, I think it goes back to, guys, like this comment that I say all the time. Say it for you, Dan, that a small cap growth manager said to me 2 years ago, explained everything in cannabis, was an analyst. He said, "Very cool story, Jesse, but how do I play the game if I don't know the rules?" And that always struck me. And that's why I say it so much on the show. And I don't think it's different today. Like, these companies uplisted, and if you're a sophisticated investor, like, you still don't know how this shakes out. You don't know what the rules are. So you do one of two things. Either you make a bet on what you think the rules will be, which everyone's been burned on 97 times. So people don't want to move ahead of these things, or you chill out for a while, figure out what the rules are, and say, I'll make a decision in 3 months. Not a big deal to me. I'll just wait and see what happens here. And I think that's where we are. I don't think people hate those companies. I don't even think it's necessarily apathy. I think it's a calculated decision to say, wait till I know the rules, then I can decide if I want to play the game.
100%. So people are waiting on those rules. And part of what you just said, Jesse, was after they've been wrong 97 times, how many times has safe banking been floated? How much did these stocks pop when Joe Biden was running for president and said they were going to legalize? How many times, to be blunt, have cannabis investors been burned? And it doesn't matter if you're Wall Street or you are an individual investor. They've been burned. So yes, they're absolutely going to wait for, we call it clarity. We're going to wait for clarity. And so much more is to be determined. Now, here's another thought for you guys. Let's see what you think about this. For people that say, where's the growth? Because are these fast growth companies now, or do they look great? If you're a micro cap investor or even a small cap investor, sometimes people hate it if I call these cannabis companies micro cap, because a few of them are small caps. You expect explosive growth. You expect explosive, fantastic looking financials if you're a small cap or micro cap investor. We don't really have that among these cannabis investors, the cannabis companies, excuse me. So where's the growth come from? Well, we got to get 280E to go away. I mean, really go away. I mean, it's gone away for Glasshouse, sort of, yeah. And it's gone away for a big part of TrueLeaf. They had to, separate out the adult use states. But we need 280E to go away. That adds a lot to the balance sheet. We can talk about how they're treating those tax provisions, but we need all the CBD shops and the hemp business to go away. And yes, I know there's people in states that need and want products. I hope that state licensed legal dispensaries get to continue to expand in places that they don't exist yet. But yeah, it's been a really unfair playing field with the billions of dollars in sales that are going into CBD/hemp-based products that we hope and think most of will get redirected into licensed legal, state legal dispensaries. That's really a 2027 story, probably. So, and then we got additional states coming online. So I think the actual growth numbers of the underlying companies might look a whole hell of a lot better in the future. And that's another little side story besides what you already mentioned, Jesse, of these people need clarity. They need to know the rules. They need to know how it's going to work before they're really committed to investing. Thoughts?
Do we lose Morgan again?
Morgan.
Morgan looks discouraged. He is very discouraged.
I'm here. I'm just passively waiting.
Yeah, you're good. Yeah, I can talk for a little bit. We've got like just 5 minutes or so left here, Dan. I think, one helpful thing, I'd like to get into real quick would be on the risk management side. The older I get, I'm super old, guys. I'm 51. And I feel like the older you get, you realize life and investing is first and foremost a risk management game. If you can cut those losses and get some wins on the upside, things work out pretty well. But where you get really buried is if something goes down, like we've seen in cannabis, like there's been, a 90% drawdown, and MSOS peaked on February 10th, 2021, at I think $55 a share, Dan. And here we are now, back down around $4. And so that's when the sector at large. So I'm not saying, I'm not assigning responsibility for you for that whole macro change, but in your portfolio,
well, some people would,
yeah, I see that. I know their X handles. And so I'm curious, like in the portfolio, like how do you think about risk management when kind of everything is going against you? Like how do you decide when to cut an individual company or when to start trimming a name?
And again, I'll go back to something I was sort of giving thoughts on earlier, that managing this fund MSOS is unlike anything I've done in other funds. We have the psychedelics fund, and about a year and a half ago, we launched HVAC, which has been a great fund, heating, ventilation, air conditioning, and it is a picks and shovels play on AI and data centers. So we have this industrials fund. I'm only mentioning that, besides plugging ourselves, I'm mentioning that because I can manage those funds much more tactically. I have, criteria that I very much use that looks at certain analysts that have high ratings. I look at chances of earnings revisions. I look at chances of earnings beats, and we have some quantitative tools to try to use those things. And so if one of my stocks pops up to the top of the list that I have on the watch list, and one of the stocks that I own, I will completely tactically sell that stock, buy a new stock, add it to the portfolio. And I can do it as an actively managed fund on any schedule. So on any given week, I am making changes tactically. Psychedelics, I have a smaller universe. So I'm rarely completely changing a position, but I'm rather constantly adding to certain positions, trimming positions. In the heating, in the HVAC fund, I am every week killing off some positions entirely, adding some new positions. But I also do it carefully for tax purposes to not cause taxes. Do I do any of that in MSOs? No, I really don't. I really don't, because limited universe of stocks. I like the makeup. If it's in the top 5 holdings or so, which I'll go ahead and rattle off: Curaleaf, Trulieve, GTI, Glasshouse, Verano, Cresco, TerraSend. If one of those stocks goes to zero, we're all fucked. Sorry for the word, but does anybody in their right mind think that I can sell 24 million shares of GTI in any short period of time, or want me to try? No. Now, here's another thing. This fund that owns virtually all the tradable multi-state operators in the US, it owned cannabis. Now, was everybody buying cannabis, formerly Columbia Care, 4 and 5 years ago? Yeah, everybody was. It was going down. It didn't look good. But I owned 20 or 30 million shares of it because this is $1 billion MSOs fund. Jesse, do you think I should have sold it?
Yes.
Who would have bought it?
No. Yeah. So what you're saying, Dan, is you kind of get, for lack of a better term, stuck in some of these positions, your forefronts, your airs, your cannabis, your gold floors, where it's like, you're not a dumb guy. Like, you'd like to get out of it, but getting out of it, are you saying would just crush the name? That'd be counterproductive?
It would crush the name. Would anybody have invested in cannabis over the last 5 years if we had a time machine, or we knew where we'd be sitting right now? All those questions. No, of course not. Of course, it'd be nice to go back in time. Hindsight's 20/20, very, very, very easily. But to go to these questions, I'd look at my screen right now. Here's something that's, I think it's really relative. Today, Curaleaf is down 5.7 million in the portfolio right now. Trulieve is down 4.6 million. GTI is up 2.1 million. That's nice. So when cannabis was going to zero, its entire loss for the past year was less than on 1 day's up or down for any of those stocks I just mentioned. I'm saying that, and again, it's hard to understand, like, oh, why'd you ride cannabis to because it was immaterial to the fund. Losing maybe $2 million on cannabis, when losing $2 million on cannabis was basically ish. It was unsellable, pretty immaterial to the fund going up and down every day. Now, if I had hindsight, I would have sold the hell out of it 3 years ago. So,
right.
So another way of saying it is you're just kind of like, to your point, is like the top cohort is pretty well anchored and you're letting the market kind of drive it from there. So like some of these ones that you're just, if they drop out, it's not impact like that bad for the fund, and letting the winners just continue to push to the top.
Now I'm going to skip ahead to, Jesse, told me some questions he might want to ask me today, and he hasn't stuck to it very well at all. But now this is a great discussion.
That's my.
I'm looking at the portfolio right now, and I only have $3.2 million worth of Vario. I would love to have more Vario at this point. Vario has only traded 15,000 shares today. It's turning into a serious tier 1 company for its footprint and its reach and everything else. They're doing a great job, but it doesn't trade much at all. If I have money in my hand, that's a stock I might add to. I go down the list a little bit further. I got Planet 13 in there. And I got tens of millions of shares of Planet 13. It's not really bought or sellable, so I'm glad they're merging into Vario. That's a neat thing. Ascend, I don't have much of that, but I possibly would add more to that. But then you go down the portfolio. Oh, Vext is pretty solid. I have less than $1 million worth of Vext. It's only 18 cents a share. Pretty good company, pretty good operations. That's a stock that I could possibly add more to with cash. But there's other companies in here that are in here. They're representative of the overall MSO space, but I might not want to buy them today. If somebody gave me cash and I was putting it to work, there's certain companies in this portfolio that I would add to. There's certain companies that I would not add to, and I'm not going to say who they are. But I'm not really looking to try to hit the bid and sell them down tactically, if that makes sense. And again, it's very different than I'd manage any of the other funds that I manage.
Yeah, it's a different mindset with the liquidity parameters that you have to deal with, which are just way different in terms of your ability to actively manage some of these names. I know, Dan, you do run a business and you've got about 12 minutes left in the trading day. Do you need to jump here?
No, I'm good.
Why don't we finish up, take just a couple of minutes, I think, and Morgan, since you're back, do you want to lead this discussion, just kind of maybe some of the more specifics about the counterparty risk? I think we covered it, but there's a couple interesting elements that are important for investors. And the big one for me, Morgan, just in terms of framing the discussion, is understanding that counterparty risk, because when you are investing, you had this in PSDN, Morgan, and we had some candid conversations about it. You should understand the whole, Scott Grossman, know what you own, trademarked. You should, in this case, know what you own in terms of the expertise of Dan, the infrastructure of AdvisorShares, but also in this case, I think it's unique. We do have that counterparty in there, so maybe you could flesh that out a bit, Morgan.
Sure. Yeah. I mean, I think it's, you covered the why earlier. Obviously, there's the benefit of the why, and so, maybe a question for you, Dan, is because it's been a few years, obviously, since we've were in the space, but how has the counterparty landscape changed? Have you seen more come in that, to your point, I think you said you have 5 now. So, like, is there a way you look at it from how much exposure you're putting with various groups, depending on, their balance sheets? Like, how much do you have to do legwork at this point? I mean, you guys are still managing, it's around $1 billion, right? In MSOS.
Yeah. It's interesting, Morgan, that the landscape is constantly changing. And years ago, we started with total return swaps with Cowen. And Cowen was very deep in the cannabis space, doing lots of things. And they were a very good partner underwriting total return swaps. And for people that don't know, these are big Wall Street firms that have big risk departments and lawyers, and they don't want risk. And so they own stock for all this total return swaps that they're owning. But then they got acquired by TD Bank and got out of the business. And we moved all of our total return swaps to Nomura, who gave us a very good deal. And I don't mind name dropping them because they're in our annual report or semi-annual reports. It's public information, and they do filings on the stocks that they own. But we use a word called capacity around total return swaps. And Nomura doesn't want to own 10% of Curaleaf. Well, that'd be really hard to do. Curaleaf has a lot of outstanding shares. They don't want to own 10% of Trulieve. They don't want to own 10%. They don't want to own 5%. So they have limits on how much of a company, any company, that they want to own. They also serve other customers that don't have anything to do with cannabis, and they only might have certain amounts of balance sheet available to buy a bunch of stocks to back up all the swaps that they're writing for people. So we also don't want to have what you guys have both mentioned of the word counterparty risk. So we don't want anybody to turn into Lehman Brothers for people that are old enough to know what that is.
I was going to say, I don't know how much our audience was around for that. So
feels like yesterday over here, man.
Oh yeah.
So we have total return swaps with National Bank of Canada. We have total return swaps with Clear Street. We have total return swaps with Merex. We have total return swaps with Cantor Fitzgerald. And the amount of companies that they are willing to own changes over time. Sometime their balance sheet and availability changes over time. How much money they have with other fund customers and other cannabis or non-cannabis products changes, and therefore the rates that we pay also are negotiable and change.
So like, just pausing there for a second. So like, obviously the chips have been just getting smoked after an epic rally. Like, is there downstream effects when there are these other like macro movements where billions and billions of dollars are being, either going up or down, or is that their willingness to, their balance sheet in cannabis and like,
and it's not a day-to-day thing and the short-term thing. So no, I haven't heard of any direct pain from what's happened with chips and semiconductors lately. But again, all of it are moving parts. And
I was just trying to give like some clarity to people, like what moving parts would like that you're feeling the downstream on.
It's funny. A big thing was there's a certain state in the United States that their cannabis commission wanted to view things differently than any other state did. And for people that are involved in the cannabis space, that's frustrating that all the states want to manage things differently. Well, they wanted to say if any company owned 5% of a cannabis company operating in that state, they had to have a representative license with the state on the ground in that state. That's a little bit, getting in the weeds of this thing, pun intended. But so companies like Nomura and National Bank of Canada and Merex and Cantor Fitzgerald says, oh my God, no, there's no way we can own 5% of a cannabis company because we're not going to fulfill that particular state's wishes. Right. So that's why we spread things out. Now, here's an interesting thing, though. I mentioned earlier that we were able to take TrueLeave total return swap and turn a lot of it into stock. I didn't have to own as much swap anymore because I'm able to custody at Bank of New York Mellon, which is awesome. So do you know which swaps I sold down and turned into stock? The most expensive ones, because I pay a different rate at National Bank of Canada as compared to Nomura, as compared to Merex, as compared to Cantor Fitzgerald. They have different rates. I keep the biggest balances with the cheapest ones. And if I need to trim, I trim the most expensive ones. Simple as that.
Do the cheapest ones have higher credit risk though, Dan? Or are those credit ratings similar across the board?
I think they're very similar across the board, and the companies I'm dealing with, we believe to all be rock solid and safe. And another thing is that I'm not dealing with exotic or highly leveraged swaps. We happen to know that those companies own stock for every bit of swap that they own, which is also why I was able to close swap on TrueLeave and buy equal amount of tens of millions of shares of stock and move it to the fund. So it's always an issue. What are the credit ratings? What is the counterparty risk there? But the rates are not directly tied to that. It's more tied to their balance sheet availability and what they're willing to give us.
So it's a good point on the, I think you're kind of mentioning this a bit with like how much they want to have exposure with the swaps, but like, now that companies are starting to uplist, like using TrueLeave or maybe Glasshouse as an example, and you're owning them directly, does BNY, or is this like a new thing you're now having to chase where they're saying, we only want you, like you can only own so much of this company directly, and then you'd still want to use some swaps because you don't want to go over a certain direct ownership threshold? Or is that, and I don't know if that's too technical of a discussion right now, but I just was, kind of curious, like what?
Ooh, that's actually an excellent question, Morgan, that I haven't had come up directly. And my theory is that it might be for custody versus ownership on the balance sheet. So BNY Mellon is one of the largest custody banks in the world. They are custodying that stock for our fund. Our fund owns it and filings that we own it, as compared to when a swap counterparty is owning the stock just on their own books to back up the risk of the total return swap. I think that might be the different animal.
Yeah. Okay. Yeah, because I was like, and I see Noah chimed in as well, but
yeah, the fund's a record holder, so it's
yeah, interesting.
And Dan, like when investors are looking at this in terms of the return, and just to reiterate, but not to be hopefully too basic to people, but if GTI returns 10% in a year, you own it via the total return swap. Back in my days, Dan, those are like LIBOR plus a spread. I think I was at LIBOR plus a point or point and a half back in the day. Is that still kind of how these are priced, as some sort of floating interest rate plus a spread above that?
100%. Yeah, it's a real good point. And it's public information if people know where to look anyway. LIBOR's gone away, and a couple of the companies call it SOFR, and some of the companies call it OBFR, which is overnight bank rate plus a spread. So we pay for the cost of the swap. They're not free. We pay overnight bank rate plus a small spread. But on the other hand, this is an important thing. The fund has hundreds of millions of dollars in cash earning overnight bank rates.
Mm-hmm.
So we're earning a ton of interest. We're also paying for the swaps. There is a spread. They're not free. But it's not huge.
So just to flesh this out a little bit, so far I looked, is at what, 3.65 right now? I don't know what Dan's rates are, point and a half. I don't know exactly what it is, but probably pushing 5 all in on that cost, but offset and some interest against the cash over there. So I don't know exactly where that works out, but somewhere between 0 and 5 for sure, Dan? Does that like a ballpark range? Probably closer to net 3 or 4.
Yeah, you're in the ballpark. And
Okay.
and again, one counterparty charges one rate, another counterparty charges a different rate, and I try to keep larger balances in the lower rates. And I also want to keep all those doors open because, knock on wood, I'm hoping for hundreds of millions of dollars of inflows again to this fund when things change and the outside investing world takes sight of cannabis investing once again. So I'm keeping my doors open on the swap capacity, we call it. Mm-hmm. But yeah, you're in the ballpark of the cost. And again, hey, for anybody out there, mutual funds inside your 401k, ETFs, all of them have fees and expense ratios. If somebody thinks they want to, just buy stocks on their own, knock yourselves out. Good luck with that. But the beauty of the ETF is that it is one fund. It's one purchase. You're not going to get a capital gains distribution at the end of the year. It's tax efficient. And but there's fees. It's not free.
Yeah.
There's pros and cons there.
There's a cost to the financial engineering you were doing.
Yeah. And you know what? The thing about if and when we hope all these U.S. cannabis companies can get uplisted, I am going to convert as much darn percentage of that as I can into non-swap, into direct stock. But I got to remind people, I'm still going to use total return swaps. And the reason is we have this fund very purposely super top heavy in the top holdings. And if you look at a regular mutual fund or regular ETF, it is not that top heavy. That is not allowed under the Internal Revenue Code and the 1940 Act, diversification, concentration rules. So that's a big part of the reason that I haven't converted all of TrueLeave to being holding it directly, because I fully expect to be doing the same thing with Curaleaf. Well, I've already done a lot of it with Curaleaf because they're listed on the TSX. So I misspoke. I fully expect to be doing it the same thing with GTI and Verano and Cresco in the near future, because of I'm so concentrated and I got to meet the diversification concentration rules.
So is that how like the single stock ETFs, they're just using a swap, right? Because they
100%.
Yeah. So it's like anyone that's buying for whatever reason a single stock ETF instead of just buying the stock, that's their get around.
Yeah, back in the old days, we used to tell people, because people would come to us and want to develop an ETF, and they'd say, we want to own 10 stocks. And we'd say, no, you can't do that. You have to own more stocks than that, or you're not going to fit in the 1940 Act rules. Now there are single stock funds and there's super concentrated funds, but yeah, they're using total return swaps. Total return swaps are very normal, very common, and there's trillions of dollars in it. It's not unique to cannabis investing. People need to understand that.
Yep.
We're about at the hour here, guys. Anything else? Dan, it's been a great discussion. Anything else you want to touch on before we let you jump?
There's lots of things I want to say. No, it's been great, guys. I hope this is good education for people is the main point of doing this. I think you should know what you own, understand what you own. And we all hope for better times in cannabis investing.
Yeah. We're overdue, guys. Well, we'll be closing out by saying thank you to Flowhub for making today's show possible. Whether you have one dispensary or 166 like Curaleaf, who happens to be on the TSX, having the right technology is more important than ever. That's why so many top retailers choose Flowhub. What you need to do if you have a dispensary is go to flowhub.com, book a demo today, and see what is possible. So thank you to Flowhub for supporting today's show. Morgan, I appreciate you. I know you had some tactical struggles today. Don't beat yourself up. We all have bad days. You made it back in the end. I'm proud of your perseverance, Morgan.
That's what we do in cannabis.
Exactly. It was kind of a cannabis experience. Yeah, you took a bit of a beating today, but you started to come back at the end. So that was nice work. Yeah. And Dan, really appreciate you coming on. We should have had you on sooner, and I hope we'll see you back again here soon. So thank you to everyone listening. Again, if you're on YouTube, that's been fantastic. Hit that thumbs up button, like, subscribe, even hit that bell so you know when the new shows will come out. We're going to be off for about 2 weeks. I've got earnings next week, and I can't deal with additional stress. And then I'm finally taking vacation the following week. But we're still good for 2 shows in August. We'll just cram those into the back half of the month. So look for those sometime the 3rd and 4th week of August. That's it, guys. I've had it. We're out of here. The views expressed in this podcast are provided for informational purposes only. Nothing we said should be considered research nor recommendation. All investing involves risk. You know that. You're investing in cannabis, including the loss of principal.